Dave Ramsey gives some great finance advice for the masses. He's helped an incredible number of people gain financial footing with their money through his finance course, books, radio show, and YouTube channel. He advises people to pay off all debt, cut up your credit cards, and invest for the future. Those seem like common sense, solid principles to get ahead. Perhaps avoiding all debt is an overly conservative strategy when you consider the possibilities of investing with leverage. How does Dave Ramsey recommend people invest their money for retirement? Specifically stocks, bonds, mutual funds, or real estate? What if you get a discount on your company's stock? Should you just take advantage of that discount and direct the entirety of your savings to that? He's been known to say that a 12% average return is reasonable, so what should people be investing in to ensure their investments are performing? Let's take a look at what Ramsey recommends for a retirement portfolio. My name is Chris, and I help teach people about money, personal finance, and investing. If you're interested in improving your financial future, make sure to subscribe to the channel and hit the like button if this video is helpful. Dave Ramsey specifically recommends mutual funds despite their generally high expense ratios, some of which charge a commission when you buy and sell. His strategy for picking successful investments is to look at which mutual funds have historically outperformed the market. This means only buying funds that have at least a 10-year track record of outperformance. Although he wouldn't own an S&P 500 index fund, there's no problem with that if you want to mirror the market, but Dave prefers to own investments that beat the market. If the mutual funds aren't going to outperform, you might as well buy an index fund that tracks the market and is less expensive to own. In recent times, mutual funds that charge high fees have lost popularity to lower-cost alternatives that have very little expense ratios. Dave Ramsey would prefer to pay more for a fund that he thinks will perform better than the market. On the surface, that's a great idea, but when you consider the fees being charged, it might not be as profitable as it seems. The expense ratio is charged based on the entire value of your portfolio, which can eat away at your returns, especially since they're charged whether or not your investments lose or gain value. So what type of mutual funds does Dave recommend? Firstly, he suggests that you use his affiliates to help with financial advice, but he wants investors to spread their money across 4 different categories. He suggests allocating your portfolio equally across these 4 funds. Growth and income. These funds have a history of stable growth that also pay dividends, giving investors the best of both worlds. You might find these listed under the large cap or large value fund categories. They can also be called blue chip, dividend income, or equity income funds. Examples of these types of stocks are Home Depot, Apple, Microsoft, and Johnson & Johnson, all large and stable companies. Growth. These funds are made up of medium or large U.S. companies that still exhibit signs of growth. This type of fund is likely to rise and fall with the economy, but you'll still get some stability that's associated with larger companies. They can also be called mid-cap, large-cap, equity, or growth funds. Examples of growth stocks are Google, Tesla, MasterCard, and Nvidia. Although higher risk than a growth and income fund, they're still reasonably stable due to the nature of medium and large companies. Aggressive growth. These funds are the wild card of your portfolio, providing the highest risk. When they're up, the returns can be phenomenal, but if the economy does poorly, they'll underperform other holdings. In the long run, this type of fund is going to perform very well. There are a variety of aggressive growth funds, but they tend to hold many technology companies, with many of the same holdings as a regular growth fund. International. While most of your portfolio will be made up of U.S. stocks, an international fund will give you a chance to own large, international companies that you've probably heard of, like Nestle, Samsung, and Toyota. These are great because you increase your diversification and aren't limited to the United States. That way, your portfolio is less likely to experience huge losses if the U.S. economy tanks. Having called the decision to own a single stock stupid on his show, it's clear that Dave doesn't recommend owning them. He owns 0 individual stocks because there's too much risk, despite his estimated net worth of about $55 million. Employees often use much of their retirement contributions to purchase stocks of the companies for which they work, because it's offered to them at a discount, usually 15% off. In some cases, workers will invest the entirety of their retirement into their company's stock, amounting to a huge sum over time. This can be extremely dangerous if you're not properly diversified. He does make it clear that it is okay to own single stocks, but to limit the allocation to no more than 10% of your portfolio. Never invest in something you don't understand. You're in charge of your finances, so you want to know the details of your accounts and their holdings. It's important to understand how much you're paying in fees and how those will affect your portfolio over a long period of time. Don't let an advisor sell something to you that doesn't make sense. Do your research so you know what you're buying. Don't simply chase returns. Before you commit to purchasing a fund, consider the big picture and how it's performed over time. Look back 5, 10, or 20 years to get a good idea. Look for mutual funds that continue to perform well year after year, and don't get upset if some of your holdings perform worse than other funds you own. During some periods, aggressive growth funds will perform really well, while the growth and income doesn't. Other times, the growth and income will have much better returns than aggressive growth. Choose quality funds and hang on to them. Earning stable returns over a long period of time is much better than trying to make huge gains. Leave your investments alone, particularly when the market goes down. You might be tempted to cash out your 401k or IRA for fear that your portfolio will drop and not recover, but this is one of the biggest mistakes you could make as an investor. Don't touch your accounts until you're ready to retire. Not only will you owe taxes on the withdrawals, you'll also owe the IRS a penalty if you're below the minimum withdrawal age. Lastly, selling at the wrong time could leave you with huge losses that would have otherwise been recovered had you waited a little while. You have to think long-term when investing and ignore the daily and monthly fluctuations of the markets, having faith that you'll profit in the long run. If you understand real estate and don't mind taking on the responsibility of becoming a landlord, Dave Ramsey recommends it as an investment. But it must be purchased with cash, never taking out a loan, and add 3 to 6 months of expenses for vacant property to your emergency fund for instances when you're in between renters or the tenants refuse to pay. Don't even think about using a loan to purchase property, despite the increased returns you might see from using leverage. Paying cash takes debt out of the equation, lowers your risk, and sets you up to earn more cash flow right away. To sum up Dave's real estate investing advice, pay cash, diversify, stay local, and start small. Dave Ramsey doesn't recommend bonds at all, which might be a surprise considering his conservative investing principles. Instead, take that money and park it in a growth stock mutual fund that will provide higher returns. Bonds are less volatile than stocks, but the returns are far less. People are attracted to bonds for their steady income, and that stability makes it easier to budget. But the amount of risk relative to returns is much better with mutual funds. In other words, bonds are less risky than stocks, but not much less risky. The returns, however, are much less than the amount of risk would suggest. The returns from bonds barely outpace inflation, and you want to beat the market so you can build wealth.